is actually a Mosley, Virginia.
Good afternoon and welcome to New Knowledge. And today I'd like to welcome Ms. Denise Mosley, who's with Highland Union Bank. Thank you, Denise.
Thank you.
For the financing a small business.
Okay, great. Well, thanks everybody for having me today. Just a little bit about me. I've been in banking for 20 years, and I've been in business and commercial banking for the last 13 years. And I'm looking forward today to sharing some information that I think would be helpful for a small business owner to be able to understand a little bit about what a bank or banker are for when you have a loan request. So I've prepared some information for you today that will be available here at the center. You can call Sandy and get that information from her. So today what we're going to be talking about is what are the small business responsibilities to a lender. And I'm not going to read everything on page 1 that we have, but if you're seeking to establish a financial arrangement, which would be a loan, you're going to ask to submit these kind of documents. Professionally prepared tax returns for 3 years, financial statements of your company currently, a list and a value of what collateral that you are going to present to the bank to be able to be used. And if you are a receivables type company, we're going to ask you for an aging receivables report. And the reason that we do that is we want to see how are you collecting what people owe you. And we also may ask for an accounts payable receivable report or accounts payable aging report to kind of see how you pay your vendors. So some of the basic questions that you can ask yourself is, okay, I've got this business, how much money do I need? And can the bank help you with your present need and your needs? And what type of businesses would Highlands be interested in financing? And then also, what kind of collateral do we accept and what do you have to offer? And so some of the things that you might want to find out before you meet with a lender is, for one, you find out from the bank, what are the rules for their business loans. You want to ask for a loan application. You want to make an appointment with a business banker like myself. And you need to remember that the bank is just like a customer. You have to convince us that your business has merit for us to be able to take the risk and give you money. So one of the things that I would ask, and I ask this a lot, is how much money do you want? And how much have you invested or are you going to invest in your business? And how long will the money be used? How long do you need to repay the loan? How will the loan be repaid? Most of the time it's going to be cash flow. And what collateral do you have to offer? And a lot of times, just in my experience as a banker, I will get people, business owners that will say, I need a line of credit. And I'll say, well, why do you need a line of credit? And they'll say, well, because I want to purchase a truck, or I want to purchase equipment, or I want to, something that is really, that's not a good use for a line of credit. A line of credit is short term. I always like to tell people, think of a line of credit as a roller coaster. You start down here, you've got a project, or you have something that you're going to be working on that you need your overhead covered, or you need to buy materials or something. Okay, you use that line of credit. You're up here at the top, so now you have a balance on your line of credit. Well, that job that you had to use those funds for, they were paying you. Okay, so then you take that money that you earn from that, less, hopefully you make a little profit on it, and you pay that loan down. A line of credit should be like a roller coaster. You use it, you pay it down. You use it, you pay it down. And a lot of times, a bank will require, it's really not a 12 line of credit, it is an 11 month, because they would require a 30-day pay to zero at some point in time in that year time that you need to have to zero and rest it for 30 days. You will hear that about lines of credit from bankers. You need to rest your line of credit. A lot of times, lines of credit are not monitored if they're amount $25,000, $50,000, but when you start getting into the $100,000 and up, they are going to be monitored. And your banker will probably want to look at your financial statement every year and get a tax return every year. So be prepared. Your banker should be your financial advisor, and you need to be able to give them everything, whether it's good or bad. Share that information with them on a yearly basis. One of the next things that we use as a lender and a banker are the 8 C's rule. Your personal credit score is one of the most important things that you need to know, and it must be good in order to get a loan. You have to have capacity, the ability to repay your loan, and the capital, what money you put to your business. We look at that as well. Collateral, what are the assets that are going to secure your loan? A lot of times a line of credit is unsecured, but we secure it with a UCC filing of all your business assets, because you may not have enough collateral in your business to be able to secure a fixed piece of collateral. We also look at character. We look at you. How do you pay your bills? How do you do business? We look at conditions, the economy, your finances, anything that affects your business. And your commitment. What is your ability and willingness to succeed? A lot of times that will be proven in a business plan. And then one of the major things that we look at is cash flow. Can your business support this debt and its expenses? So those are the 8 C rules that we look at. And then when we talk about financial statements, it's like, what does my banker want to see? Well, we want to see a balance sheet. And that's really just a snapshot of your business at a moment in time. Same thing you'll hear a lot, I need a personal financial statement. Well, what that is that's you personally outside of your business. We want to get a snapshot of that. And the numbers are going to change on a daily basis or a monthly basis. And you should know what your balance sheet is before and after your financing. An operating statement, which is an income statement or a profit and loss statement, you'll hear bankers say, I need a P&L. Well, that's what that is. And basically what that is your business report card. It's your expenses are subtracted from your income, and it gives us the net profit or loss over a period of time. So a lot of times, like if someone came to me today and wanted to do a loan, I would require 2 years of tax returns and your interim financial statements for your business through, this is September, probably you would have it through August. I would want to have something that was a month end. And then you may also have prepared a projected profit and loss statement for the month end of September or October or even through the year. So if you have that, that's great as well. And again, like I said, we do require a personal financial statement, and that's really just shows your personal assets and liabilities. One of the other things, a lot of times people will give us tax returns, but they won't give us the entire package of tax returns. We need all of the schedules that would go with it. And a lot of times people prepare their own tax returns, and that's fine. And what we do is we do verify that with the IRS, just to make sure that what we're getting, the information that we're getting, is the information that you shared with us. Does anyone have any questions about anything so far that I've covered? Any comments? Anything that's just burning on your brain? Okay. A lot of times people really don't know what type of loan do they need. So it really depends. It depends on what the purpose of the loan is going to be and how long you are going to need to repay it. And a short-term loan is really something that is less than a year, which could be a line of credit. It could be a credit card. It could be money that you may have in a CD that you just want to be able to use the funds that you have for short-term purpose in your business. And then a term loan is going to be anything that is longer than a year. It could be an installment. It could be something that you want to be able to pay every month. It could be for working capital. It could be for inventory, expenses, machinery, equipment. and leasehold improvements. And a longer-term loan could be used to purchase real estate, major improvements to a building or major equipment. Those are kind of loans that are determined with a buy-sell agreement, appraisals, and quotes. And I think I have a teammate here that will introduce real shortly. Come on in.
Good afternoon. Apologize for being a few minutes late. I got stuck at the office. I'm Bert with Highlands Union Bank. I've previously been in the retail branch sector and recently moved over to a credit analysis department. So we can help talk about some of the numbers and things of that nature. Go ahead.
Okay,
continue,
great. Some of the things that you'll need to bring when you meet with me would be your business plan, if you have one, a completed loan application, and any other materials we may have already discussed on the phone that I've asked you to bring with you. I want to keep your time short as possible, so we can, I'll pre-position someone on the phone and kind of talk about what it is that you're wanting to do, and then tell you the information that you can bring, because I know your time is valuable if you're taking time out of your business. So I can give you an overview and an outline at the very beginning, and I'd like to see your business. A lot of times I prefer to come to you so I can see your operations, what it is that you do, because I'm real passionate about understanding exactly what it is you do, what you're trying to accomplish, and where I fit into that little piece of the puzzle. So, and then a lot of times I will tell you when you can expect a decision. And Bert and I are going to become very best friends, because he will be doing a lot of my underwriting for me and analysis on financials that we've talked about. So would want to, I like to let you know what to expect. And also, if you go to a bank and they give you a decision via the phone, it's always a good idea to get something in writing. That's just for yourself. You need to have something in writing. And a lot of times people will not have a formal business plan or a formal letter of a request for a loan request. So I've just kind of put a sample cover in here, and it basically, you can fill in the blanks. But this is very helpful to a loan officer if we can see what it is that you're trying to get a little bit of information about your company, what your goals are, and basically what your request is. And then another thing is the business description. I need to know what it is you do, and this is just a little sample to help you, and it may help you also uncover things about your own business that you didn't think about sharing with a banker. So one of the biggest things are, you've got a request, you want to know, well, how long is this going to take, and what do they look at, and how is this going to work? So what I want to share with you now is our 1, 2, 3 method, and it's basically how we calculate how much can we lend to you. A lot of it's, going to be on all of the C's that I've already talked about, but some of the things that you'll hear, or you may hear from a banker, would be discounted collateral, or also what is your collateral coverage. So if you think about it this way, for every dollar that you borrow, it must be covered in $1 of a collateral, a piece of equipment, a car, whatever you have. So we look at that as a loan amount. And I'll put an example in here just so you can kind of see how the formula works. Let's just say, for instance, you had the inventory of $30,000. Well, as a bank and a banker, we look at inventory as a 50%, we'll loan on 50% loan to value of that collateral. So we're only going to be giving you $15,000. If that's all you had, that would be what we're going to be looking at as a value. So, and in this example, this just kind of is a nice round $100,000 number. But the max on that loan request would be $55,000. So that kind of helps you understand where the bank is coming from and how and not every bank is going to be 50% of inventory. This is just really an example. Some banks will loan more than that on inventory or less. It depends on the inventory. And if you're looking at doing a loan on inventory, you actually want to look at how long has that inventory been in your possession. Because if it's outdated and obsolete, we don't really give that any kind of credit. So, and then the next thing is debt service coverage. You will hear a lot about this from the banker. And I've put some examples in here, and really this is about your company's business, your company's ability to pay this loan back. We like to see, most of the time, the debt service coverage, we like to see a 135. It really just kind of depends. It's going to depend. But one thing that I would caution and advise strongly every year is to pull your personal credit. You need to know what is out there, and I can tell you in the last 20 years, a lot of times people don't know what's on their credit report. And they go to get a loan, and it's like, your score is really low, you don't even meet our minimum, and they don't understand why. So we advise them, if you're turned down for a loan, you can get a copy of your credit report for free. But you can also, there's free reporting agencies out there, you get that every year. And also, a lot of credit cards now are given a FICO score, which, it's the Fair Isaac score. And you can monitor that every month. Your score can change every month, depending on what you do with it. And there could be things that are reported incorrectly on there. You've got to get those fixed, because your personal credit score impacts your business loan, your personal loans, everything, anything. I mean, even if you want to go and get credit with a vendor, like, if you were in construction, Lowe's or Home Depot, if you don't have a good credit score outside of your business, you're not going to get that trade line. So it's extremely important to get it. Some of the common financial problems that I've known about and I've heard about, and that are very common, are there's little or no record keeping. I don't have a bookkeeper, I do it. I'm so behind, I'm 6 months behind on my books. I need to have some time to catch up on that. That is something that you have to keep track of at all times, because as a banker, I'm going to ask you for your financials. I need to see them. And then failure to seek outside help. There are excellent resources. Your chamber is an excellent resource. This incubator is an excellent resource. You have small business. You have SCORE. You have the SBDC. All of those things are available to a small business owner. Another common financial problem is financial management. How you actually manage your finances within your company or outside. It's your money, and you should be disciplined. That's the way you need to look at it. And then the other financial problem that I've seen on a regular basis is the business owner wants the bank to take all of the risk. You want to start a new business, and it's going to cost $100,000. Well, what's your skin in the game is what I call that. What are you putting in it? If the amount is zero, then you're asking me as a bank and a banker to take all of the risk. And we're not going to be able to do that. So you've got to have some money to invest in it. One of the other things, and this slide kind of got out of order, was the debt to worth leverage. And one of the things that you can look at is for a business can borrow $3 for every dollar that it is invested in it. And you can assume on the little example that I've outlined, ABC wants to refinance a $75,000 loan, and the business has assets of $100,000, liabilities of $75,000, and a net worth of $25,000. Well, the maximum loan based on the equity is $75,000, 25 times 3. So that's kind of where you can get those little ratios at as well. A lot of times a startup or a very young company and business will not qualify for a true commercial loan through a commercial business banking or, so what are the parameters? Well, the SBA offers some really good programs for businesses. We like to do SBA loans because it takes the risk of giving you all of that money up front. It takes that out for us. And kind of the way the SBA works is they have a 7A program and they have a 504 program and they also have an express line program. And what they will do is, the 504 is really for real estate and kind of equipment. The 7A program could be for a variety of things outside of even a working line. So what you do is you apply for the SBA loan. You can work through an SBA preferred provider, which Highlands can do the SBA 7A and 504. The rates are generally lower, and you can have a longer term. It's not traditional financing per se if you just went to the bank to do it. And if for some reason you defaulted, the bank has less risk and is paid by the SBA for the amount that is out there. You are still on the hook for the SBA loan, even if you default on it. You're still on the hook for it. But there is a ton of information on the SBA.gov. If you have not visited that website, you should go out there because there are business plans, financials, anything that I've just talked about is out there on SBA. A lot of times, and I put in here, how does the SBA guarantee work? And this is an example. The SBA will, this is a $65,000 loan. The SBA is going to guarantee 75% of that. So if this example is if you defaulted, this is what would be returned to us. So we're not on the hook for anything. So that's why banks like to do SBAs. A lot of times you'll hear, well, they take too long, this, that, and the other. That's not really the case. It's when you have a complete package, and that's what I tell people, that, well, how long is it going to take? When you have a complete package, and I don't have to come back to you for anything else, it's a smooth deal. So one of the things that we also get is you don't qualify because you haven't been in business long enough. Typically in the world that I live in, I like to see 2 years of tax returns. If you have 1 year and you're like right now, that might be something that's doable. But if you're just a startup company and you've been in business 6 months, we're probably not going to be, and I will tell you that up front, I can't do anything for you right now. However, Bert, that was in our retail side, we do have some alternative startup financing. A lot of times you can do a home equity line of credit, and I'm going to let him expand on that. Also, you can do a mortgage refinance with cash out to put into your business, or you may want to do a personal credit card. So I'm going to let Bert talk a little bit about how the home equity line works and also the mortgage refinancing.
Yeah, so under the alternative financing, coming out of the retail side, we saw a lot of people that have maybe been in business 1 year, 2 years, or something like that. I think as we spoke, the unwritten bank industry standard is for the business to be established for 3 years before they can really look at the business as standing on its own. So if you're 3 years or less, you're kind of in a little bit of a gray period. Now, that doesn't mean there's not options. There are. Some of them are alternative. SBA is a great product that I've used before to help people that are in that 1 to 3 year stage, to help them get some extended terms, a little bit of better pricing. Maybe we can lend a little bit more against the inventory and equipment. So maybe the bank's policy is at 50%, but if we go with SBA, we can get up to 70%. So that gets you a little bit more money to use for capital. Then, as we were talking, the truly alternative, one of the go-tos in this day and age is looking at a mortgage refinance. So if you own your own home, and you've got some equity built up in it, maybe you've worked at a company for several years, you've paid your house down, and now you're starting a new venture or something of that nature. Sometimes you can refinance and pull some money out there. The benefit to that is typically we can go through one of our partners in the bank or any bank, and you can get 15, 20, 30-year fixed payments at a fixed rate. So it's usually the cheapest way to borrow. I mean, you're talking rates in today's world in the 3.5% range, which is unheard of. Another alternative, maybe it's something you just need, it's going to be short term. Maybe you don't need a real long-term payment, is the home equity line of credit. Very similar situation. It can be if your house is paid for, it can be in the first lien position, which means it's a first mortgage, or it can be behind another mortgage. Make math easy, let's say you have a $100,000 house, you owe $50,000 to Brand X on a first mortgage. You could probably pull out another $30,000 to use at your discretion. The benefit here too is with most people's home equity line of credits, we don't monitor what you use the money for. So, you know, if you're wanting to buy inventory, equipment, things of that nature, it's not monitored. If you need it to make a little bit of payroll, it's not monitored. When we go over to the commercial side, the use of funds is monitored a little more. We don't really like to lend you money just so you can go make payroll for the next 3 months. It's typically just been a losing-lose for the bank in the past, is why they don't do it. Home equity line of credit, we don't monitor it. My standard joke is we close it, it takes 3 days, you have access to the money. Hey, if you want to go to Vegas and put it all on black, go for it. We wouldn't suggest you do that, but you can do it. So you've got that. In addition to that, you've got some really cool things like it's got interest-only payments, no closing costs, so you don't pay typically anything for the home equity line of credit. Whereas when you go over to the commercial banking side or a mortgage refinance, you need to expect a little bit of fees to be involved. Covers the cost of operation. Another good thing is a personal loan or an auto loan or something like that. So maybe you rent, or maybe you don't have any real equity built up in your house, but you've got a car and it's paid down or paid off or whatnot. You know, we can also evaluate that. You know, you're probably not talking, depending on what kind of car you have, and you may not be talking $30,000 out the door, but we'll use my old beat-up pickup truck I drove in as an example. You know, the thing's probably worth $15,000 maybe. So if I was starting a business, whatever business that might be, I was going to start Bank of Burt. You know, I could probably go to the bank, and I wouldn't get anything on the commercial side because they know I don't really know what I'm doing. But I might be able to go to the branch side and get a car loan, and I might be able to get $10,000, $11,000. You know, here again, it's going to have a fixed rate, it's going to have a fixed payment, and once you walk out the door, you can do whatever you want with the money. So it's not like you're going to have to turn in financial statements and all this stuff every 6 months. And that's, well, if we talked about that.
Really.
But when you start getting up in the commercial world, depending on how much you borrow, I'm calling the loan officer, and the loan officer's calling you all, because you got to turn in statements every 6 to 12 months because it's got to give me something to do during the day. And I've got to have all that as numbers to put into the little Excel sheet that they like when the auditors come in. So that's some ideas. All three of those products are very commonly available at Highlands and many other lenders. And they're all pretty competitive. They all carry about the same rates and the terms and things of that nature. But it's a very useful way for small business owners to pull some money out of it and inject into the business. And that's exactly what you're doing. You're pulling out your equity that you've worked hard to build up personally, and you're injecting it into your business. Then as the business grows and you start hitting that 2 and 3 year mark, maybe you need larger loans or something of that nature. So when you come over to the commercial side, it's a good story. You know, we were talking about down payment. We were talking about what's your skin in the game. Well, all of a sudden the story becomes, well, my skin in the game is, hey, you know, I borrowed money against my car, I borrowed money against this or whatever, and I put it in and I grew it to this, and this is where I'm at. Then it makes it easier for the bank to get comfortable in taking that next leap of faith. That's what a loan is, a leap of faith, to get you whatever else you need to, you know, to fund that next cycle of growth. New piece of equipment, new delivery truck, whatever it might be. The last, and it's on there and we disclose it, a lot of people talk about it, the last way to pull it out is through a credit card. Personally, I'd avoid that. I would look at all costs of finding another alternative. They're very expensive. Once you get in them, you can't get out of them. You throw a bunch of money on a credit card, Your balances go up in relation to what your limit is. It just tanks your credit score. I mean, I can see Sandy over there cringing when we said it. There's all things bad comes. I mean, it's an option. You can do it. There's a lot of people out there that do it, but there are ramifications on the back end, and you got to be prepared for that. It can hinder you from getting approved in the future. So I would do that as an absolute last resort. And if you're at that stage, I'd almost sit down with Sandy or someone else and really evaluate the business. Maybe there's something else that can be fixed that helps you from having to go that far.
Well, and a lot of times too, you might be able to find, they call an angel investor or someone that wants to be a partner or something like that. I mean, if you know that that's going to be a short-term use of funds on the personal credit card, that's okay, but I'm like Bert, I wouldn't advise that. That would be like the last resort. I would actually probably call someone to see if they would to invest any money in it in a certain time frame or something like that before I would go that route.
We commonly call that a private equity investor.
Yeah.
It's a friend, it's a family member, it may be a business person in the community, and there are people, even in our geographic, you wouldn't think about it, but there are people even in this area that's just what they do. They invest in people, they invest in small businesses. Now, the rates and terms are a little different than the bank, because they're wanting to make a little bit more money, whatnot, but there are avenues for that.
And the key to that too is to have a great business plan, which, I know that you guys get help with that, so that's important.
We're actually doing a business plan challenge again in January.
Okay, great.
The absolute last, I would just flat out, and our partners in the bank would cringe if they heard me say this, but I'll throw it out there. The absolute last, I would never do it no matter what, is I would never take an advance off of your merchant services. If you're in a retail style business and you take, does everybody know what merchant services is? Visa, MasterCard, payment methods. As you get in business and when you're in that 1 to 3 year phase, they just bombard you with, oh yeah, here we'll give you a little bit of money and we're just going to take it out of your daily balances or whatnot. Well, 9 times out of 10 I've seen that end horribly. I would take it off a credit card before I took it out of my merchant service processing. It messes up your revenue streams. You get all messed up with the merchant service provider. Bookkeeping. I mean, it's just goes downstream 100-fold over. That's an option. We don't even put it on the slide because as a company we don't recommend it. But be mindful, and I say that because you're gonna get that stuff in the mail. You're gonna get that phone call from whoever that provider is. They make it sound great. They make it sound rosy. Yeah, it probably works for some people, but I don't know what your experience is, but
no.
My experience is 9 out of 10 people that do it, 6 months later they can't get out of it. So that's really it, and we've got some more detailed information here on some flyers, and it's more marketing, it's more the sales end of it. This was more
for the home equity.
Or Denise, if I was a small business, and let's say that I have an opportunity at a large order, maybe I'm selling to the state of Virginia, and I've got this great big order, and I just don't have the capital to invest in that inventory, and I just need short term, because it may be 60 to 90 days before the state pays me. What would you suggest, if you were a business owner, the best way to handle that for short term?
Are you a startup?
Not going to the merchant.
right.
No, I'm an existing business.
Okay, you're an existing business. So would it be a contract? Would that be a contract, or would it just be?
Well, I would receive a purchase order from
Okay.
the state, and it could be for
Government
9,000
entity,
cases of water.
Right.
Water, I don't
Right.
know.
a government entity, we like to see those. It would be, it's really gonna go back to the C's, the 8 C's. Where are you in that 8 C's? Where are you in your credit? What's your business look like? What's the capacity if we gave this money and it was short term? The answer is that management answer. It depends.
I think what you're leaning towards that more, Sandy, is, if I'm understanding your question, is the structure of it, and typically what we would probably structure some sort of bank line of credit.
Okay.
And we would look at you know, honestly, the best time, if you can collateralize a loan, it's best for the bank, and that translates to the best pricing and the best terms for you guys. So in Sandy's example is if you had a large order, and let's say you become a state provider, and I know you've had classes on the minority and the women-owned and things of that nature and getting on that list. So let's say you go through that and you get on that list and you're selling them ink pens or whatnot, and you know you're going to have this order come in. Hopefully you've been in business for a few years, and I think that's a qualification to get on the state list. We can get the supporting financials, and then we can look at doing some sort of line of credit. And the line of credit is simply, some of them are monitored, some of them are not, but the line of credit is basically something that you can borrow and pay back,
Yeah,
ebb and flow,
a roller coaster is what I
as you
call it.
need.
So is a PO considered capital? Like if you were going to do what she's saying, is that considered capital?
What?
Is
A purchase order.
Purchase order.
Considered?
It is for some entities. It is for some entities. It is currently not really a recognized form of collateral for us. We evaluate that on what we call a one-off or an exception base. There are some entities that will lend off of a purchase order. The documentation of it is a little harder because then they've got to tie in to make sure that they're listed to receive the funds from the state if something were to happen to the company. There is options out there. Not common, but there is options.
I could see this similar for a contractor. Maybe I've got a deal with the college and that it's going to take me 60 to 90 days to do it, but it's all rolled into one, which means I have to buy the materials.
Right.
And it could be, again, a couple months, or it could be 6 months before I get paid for all of that. And I'm going to need something short term because I don't have enough bank
Right.
rolled it.
Right. And a lot of people will, in those scenarios, will probably their first line of defense to fight that is vendor credit. You know, they'll go back to their vendor, their supplier of materials. They'll go back to their supplier of ink pens. And the years I worked in retail, didn't own it, so I didn't really have to bankroll it. But I did know that, you know, we'd be ordering for the holiday season, and we'd be always asking, you know, we dealt a lot with North Face and things of that nature. We'd ask those guys, be like, hey, you know, I know your terms are net 60, but we really need net 90. Or,
Only problem is if I'm hiring, I got to hire a crew. They're
Right.
not going to take that. They want to get paid
Right.
every week.
right.
Yeah, and in that case, you need a line of credit, a working capital. I mean, it really just depends on the scope of how big that is and that type of thing. So, does anybody have any kind of burning, dying questions that they just want to ask?
I have almost a million, but
Okay,
Go
great.
ahead.
on your loan decisions, the 1, 2, 3 method, you mentioned the 3 different, items. Are they all 3 taken into account, or can you do, like just one? I guess for my business, I don't have inventory.
Okay.
I have very few fixed assets, but on the debt service coverage, I'm really high. So.
Okay.
And then, let's see 3 in here.
Well, I will tell you the 3 biggest ones that I deal with on a daily basis is your credit, the cash flow of the business, and what's the collateral. I mean, those are the 3 things that I look at most of the time. And it's going to depend on the type of business that it is.
There's some, there's some ebb and flow in that. It's not you got to hit this bucket and this
Right.
bucket. There is a little ebb and flow, and that's part of what my new role is going to be. And when I'm underwriting most of these credits that have to go on for approval, and I'm not approving them, I'm underwriting them to the policies of the bank or the policies of the state or federal guidelines. I start with cash flow. I start with cash flow. Every single time I do a memo, I start with the cash flow of the business, a global, pulling in the business income, pulling in the personal income, and putting it together to find out what kind of payment can it support. Then after that, I kind of flip with personal credit and I say, are they paying people? And it's kind of a yes or no. You know, it's a yes or no. Then I look at it as, okay, how can we mitigate the bank risk? And then I'm like, okay, cash flow's off the charts, personal credit is great. how can we mitigate our risk? Well, maybe they don't have a lot for collateral, but if we can get something, it just helps our decision process. That's kind of the stages I look at it in. That doesn't mean if you had a guy that came in from brand X and did the same job, he might do it in a different work order. So yeah, it's back and forth. So,
What type of business do you have? I'm just curious.
Well, actually, I follow the small business model of the state of Virginia. So I actually work with, my only customers are the state of Virginia and municipalities contained within the state. And I provide products to them under almost all of their NGP codes that are not regulated. So basically, our company is a personal shopper for the state of Virginia.
Oh.
We work on casual clothes, and also we bid on more competitive. Our first year in business was last year. We were 9 months with the door open, and we did $150,000 in sales with a net profit of 13% that year.
Okay.
This year, we're at $1 million to $1.1 million.
Wow.
For the end of the year. And as you can imagine, my biggest challenge is working capital. Because I purchase products and then resell. I don't carry an inventory, but I purchase on POs only. And then I resell, and then I have a 30 to, on average, 60-day turnaround on accounts receivables. My ARs have been, on average, they sit at 40 to 50,000 in any given month, and we've been up to 85,000. But I'm floating those costs. The company does great otherwise, but I mean we don't take a loss. We're not in debt. We're all good. It's a good problem to have. But I also expect that we're going to be $2 million for next year, and our biggest risk for this year has been, how do I pay and then wait for my accounts receivable? So I'm trying to get a grasp on this and what are the best decisions for our business today.
we have in the past, we're kind of taken for granted, like you said, cash flows, high, personal credit's great. In the past, we have taken, instead of inventory, we've taken accounts receivable as collateral. So in that case, we write it up as equipment and accounts receivable, and you might say, well, I don't have any equipment. Well, yeah, you may not have a delivery truck or this or that, but you probably have some things that your accountant has depreciated, computers, chairs, so on and so forth. And it's not going to be, may not be high value in any one little item, but they can take equipment and AR as collateral. What they're willing to lend against that, kind of the ratio that we were talking about a little bit ago, is decreased because of the risk. Because if something were to happen to the business, then we've got to go in and collect that accounts receivable, and we may only get 25 cents on the dollar. Just making an argument. But yes, they're
back at the state.
Yeah, there is ways to structure that.
So also our biggest challenge is that because of this and because we are basically an internet phone. We're digital.
Right.
So when we do purchases, we do have net accounts, and we've had this struggle of a new business. We're in our second year, and we're doing fabulous on our net accounts and getting them. The first one was like pulling teeth, right? So we're good on the net accounts, but even unless we purchase from so many different vendors that a lot of times we do put it on credit cards.
Right.
And we pay those, traditionally we pay those credit cards off at the end of each month. My big challenge in that area is that, I have a few like Visas and store cards or whatever. So we don't incur interest when we pay off within the month. But when you look at the credit rating, because let's say I have $50,000 in credit cards, and short and long story on that is my personal and the business, I guess business, I don't know, I haven't looked at that. I mean, we understand their vendors and we're not debt, things like that. But my personal credit is, has been sitting in the fair condition since the business has been going on. So for me, my ideal is to get $100,000 float that is in my accounts so that I can pay off credit cards on a weekly basis and ride the accounts receivable with the states so that it will hopefully bring my credit card, or my credit rating into a good range. I'm not sure,
Are those credit cards in your personal name or are they in your business
somewhere in
name?
the personal name because again, in the beginning.
Right.
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 Like Amex, I don't have a business account with Amex, but it's in the business, it's Amex. And I'm not even sure I have to look to see if I can, but most of them are under personal.
Mm-hmm.
Now the vendor accounts are certainly in the businesses, but still personal guarantee. But again, that challenge is what's the right choice. So right now we've managed to ride this ride for the last 18 months. But at any given time, I win a bid that's $20,000 to $50,000. I turn down or I choose not to bid on bidding options because I don't have collateral to turn around and purchase and get that to the state and carry that.
So you're almost in a predicament of needing permanent working capital.
Only because I haven't hit the line yet as far, because the growth, I mean, when you look at 150,000 in the first year to 1 million in the second year, that's a lot of growth.
It is.
And the projection is that will double to 2 million in the second year, realistically projected.
And where do you get those projections from?
Based on sales, based on our numbers,
Okay.
based on what I know we can manage. So this last year there was some money invested, reinvested in the company in infrastructure and growth, new hires and equipment to manage the sales and things like that. So now that's where we're positioned at this point, and we still haven't hit the, we don't have enough staff to bring to.
Right.
Yeah, right. But we could sell more if we had more staff.
So, but you've created jobs, which is a good thing.
Right.
I don't know, the SBA option might be something that you would want to look at because, you're going to have something in place for you to move from the 1 to 2 and on up.
Right.
And again, like I said, it could be a permanent working capital that you could have for your business. I'd have to, do you even have a tax return for?
We do have last year's tax return, which is how I do this.
And how are you keeping your books?
We use Sba Loan.
Okay.
Loan.
Okay.
Got a CPA firm.
Okay.
Yeah, a line of credit, maybe collateralized with AR and equipment, and then backed up with the SBA guarantee on it would probably be the best structure, is what I'm thinking. The SBA guarantee on that, while it might be a little bit more paperwork, would probably allow you to see a little higher credit limit, which would let you fund the next level of growth.
And have you been out to the SBA site?
I have been to the SBA.
Okay.
I've looked, but I've not.
Well, if you want to relook, go back out there. What I heard you say is fair on your credit. Go out there. They are going to have parameters of what that's going to look like.
Yeah. So I may not qualify because of credit.
Well, I don't know. I don't know what you might consider fair and what I would consider fair.
Well,
Might be
that's
two
what it
different
says
numbers,
in
so
the
we can
little
talk
thing.
offline on that.
That's what it says on the little things.
Okay. Well, that's a great story to tell.
It's
It's a very good example. It's a very good example of what a lot of businesses are struggling with.
yeah, that's what
Yes.
You're kind of right in between.
It's like you just need to hurry up and 6 months pass and
So is there a difference between a permanent working capital and a line of credit?
a permanent permanent working capital, under that 7A program, it's a 7-year program. The first 2 years of it are interest only, and then the last 5 are a principal and interest payment. So that's kind of how it works,
Yes.
which is a great, what you need. You know, I definitely would look at that as an option for you. Because that, you know, that kind of helps you, cash flow wise, you said you didn't have a problem. So that's not really significant, but a lot of times it is significant for people that they just don't have the money to pay even an interest payment. The cash flow doesn't work for that, but if your cash flow's good, you know, that might be the best option for you to do, is that 7A program.
And if you were to get this, how many more additional jobs do you think it would create?
And the SBA loves job creation.
That's what I'm getting at.
Yes.
And you know, like the interesting thing is we have created jobs and we pay full benefits on it. However, you know, do full benefits for
Wow.
1.5 employees. And so we have one position that will come open in January, and at that we're maxed out. So ideally, I'm looking at by the end of next year, I have to grow out in order to be able to bring in new employees. And I might be able to do it this year, but I wouldn't be able to do it because of funding issues.
Mhm.
But if I got a loan, then yes, and then probably I would say 3 to 5 jobs over the next year. So I don't know. I just saw. My challenge is that I'm going to succeed in spite of all the rules because I didn't qualify for the grant.
You guys said the Bristol, Virginia side and not the Washington County.
Oh,
So
okay.
I'm like 2 blocks on the wrong side.
Oh,
of the line.
wow.
But I came anyway because I was going to learn. And then now there was a grant offering through the Small Business League Virginia, and it's a 7-month program for coaching at high level coaching, it's executive level coaching. And I'm like, this is fantastic because this is what I need to make kind of decisions for this business. But the minimum requirements meet all, but I'm not in business 3 years.
Oh.
So I'm like, y'all are killing me. So, and that's been the whole financial challenge as well.
Well, I'll give you one of my cards, and you can call me anytime you want to talk.
Okay.
Not a problem.
But it may be a way to structure it.
Yeah.
I mean, that's,
Right. That would be great.
Yeah.
Is there a program that helps with the new hire, with there is some sort of grant or something that you can bring on employees? You asked about
Well, even when you were talking about SBA or, our Virginia Small Business Financing Authority has some programs, some loan guarantee programs that might work for you in a small business program that I was going to give you our contact for this region to call, just to see what your options are
That would be
that
great.
could open it up. And then there are training programs. If you're hiring additional, there is a small business jobs grant program that I can also give you information on. Again, all incentives in Virginia and just about anywhere is based on job creation. And I don't know if you've updated your business plan for a while, but that may be something as you start exploring, talking to Bert and Denise or anybody else that you might want to have, that way you've got it ready to share with.
I'd love the contact information so I can continue to please.
Are you listed as a women-owned business?
Yes.
Okay.
We're listed as a micro SWAM.
Okay.
So I'll have to rethink the business after 3 months. That's not an issue
And
this year.
that'd be a good problem to have.
Yeah, that'd be a good problem.
But she's the typical entrepreneur. She determined there was a need in the region or in Virginia to do what she's basically offering.
Yeah, absolutely.
That sounds awesome.
It's been-
Kudos to you.
Yeah, thank you. It's been quite a ride.
Yeah.
She don't want to move.
Yeah, I know, I swear. Well, I'm not just 2 blocks over, so when the time comes, there was that piece of it, which was, do I move now or do I at some point I'm going to move, and where do I move to? So, Washington County is probably might very well be, because there's a lot more available on that side of the line.
by them.
Yes. Used to that.
Does anyone else have any other questions or comments or something else that you just want to ask in general?
An example. that you
An
wanna talk
example or?
Speak down for everyone, please.
Okay. Well, we appreciate you all so much for letting us come out today and share some information, and we look forward to talking with you at any time that you have any kind of questions. Thanks so much.
And I want to thank Denise and Bert for doing this. Highlands Union has been a strong partner to the Chamber and to the incubator, especially in our business challenge. They've been a partner to us for the last 3 years. Hopefully we can get you on for a 4th year, and hopefully you'll be able to participate in that, because that brings a lot of great opportunities to folks in the Washington County area. We've seen so many. We can drive down the road now and see those success stories. Even though they didn't win, they're still moving forward, and that means a whole lot, because education is part of it. Just a little reminder of some things, workshops coming up. Our friend Cindy Hageman will be back next week to talk about soft skills as you're growing your employees. That's something that you might want to look at, and that'll be here on October the 5th. Following that, if running a business too is how do you convert your business into the cloud so that you always have those backups. So that will be on October the 12th. And then, again, managing employees is how can you have lead a happy team, and that will be on October the 19th. And Brandy Castle with Sonority Group will be leading that session, coming from Nashville, who's got a lot of experience. So there's some great sessions coming up, especially for businesses like yourself that are in a growth mode. All of these I think will be beneficial. But again, thank you, and thanks to those that were joining us live today. That's it.